Hey, welcome back to The Dive. Today on the show, we have Gary Wagner from thegoldforecast.com. He's going to answer all of our precious metal questions, and we're going to get his take on CBDCs and where he thinks the Fed is going next. Hey, Gary, welcome back to The Dive.
Great to be here. Thanks for having me.
Yeah, thank you so much for joining us again. Okay, so Gary, in recent news, the Bank of Spain launched an experimental CBDC program, and over in Nigeria, ATM cash withdrawals have been capped at $45 a day to push digital payments. What are your thoughts on CBDCs? Is this something that the public should be concerned about?
Well, I've always focused on hard assets such as gold and silver. And when you look at the moves to different digital currencies, to me, the underlying theme is that they are still fiat currencies. In other words, if they're backed by something other than the good faith of the government that issues it, is one thing. If it's simply fiat, meaning it's only, even the United States is only backed by the faith you have in the US to make good that treasury note or a dollar bill. To me, that's the same. So it's not something that's really on my radar. And it's not something that I look at as an inflection point.
Now, Fed Chair Jerome Powell made a statement saying that the time for moderating the pace of rate increases may come as soon as the December meeting. Where do you think that the Fed goes from here?
Well, here's my take on that. The way your question was put to me tells me that the public pretty much across the board heard what they wanted to hear from the Fed chairman when he spoke. I believe it was 2 weeks ago, Wednesday, at a conference in Washington, D.C. And in fact, he did say that they effectively want to slow down the amount of each interest rate hike. Of course, if you think about it, we've had 4 consecutive rate hikes of 75 basis points each, 0.75%. In March of this year, we saw the Federal Reserve for the first time since 2018 raise rates, and they raised by 0.25%. Following month, they went to 0.5%. And then all of the FOMC meetings following that were 0.75%. So what he's saying is that we're going to reduce that 0.75% down to 0.5% most likely. That he said it would be appropriate. But he also said that it would take longer to reach their objective by doing that. So he acknowledged that inflation is persistent. It is sticky. It's still with us. It is coming down. Last reading on the CPI was 7.7% compared to June, which was 9.1%. You can see that inflation is slowly ratcheting down in certain sectors. Food costs are still exceedingly high. Gas has come down a little bit. So energy costs remain elevated. And so the key takeaway I got from all of the statements he made is while they're going to reduce the amount or pace of rate hikes, they're going to have a sustained move. And we're probably going to see interest rate hikes and then have it maintain at that level, that high level, throughout next year, 2023, and possibly even into 2024. So because of that, I take that with a big grain of salt. In other words, they're going to reduce it, but they're going to keep raising rates to whatever they need to. And right now, it is assumed that the minimum target is 5%. Fed funds rate are 3.75% to 4% now. So that means that they've still got a little ways to go, and then they're going to leave it there. Their target is 2%, and they're looking at what's called the PCE. There's 2 basic ways that you look at inflation. The CPI, Consumer Price Index, is different than the PCE in that the PCE that they look at strips out food costs and energy costs. And the 3 primary inflationary items that are worrisome are housing, food, and energy. So 2 of the 3 get stripped out. And the reason they do that is they can't control that. Now, they can control the real estate market, and they do that by raising rates, and it makes it harder for people to obtain mortgages. but they can't control energy, and they certainly can't control the cost of food production. And so that's what's worrisome to me. I think that they're actually bringing inflationary pressures down. They are. We see that in the data. But the Fed wants to get inflation at 2%. And currently it's at about 5% if you look at the PCE, which strips out energy and food, because once you add those back in, you're back to 7.7, which is what the CPI is at.
So hypothetically, what do you think will happen if they raise interest rates to the 5% level, but inflation remains high? Where do you think the Fed will go?
They'll keep it there longer and then possibly even take it above. If you look historically at times in which the US had exceedingly high levels of inflation, they typically raise the interest rates above the level of inflation to bring it down. The Fed hasn't done that. And it was hard for them to do that because they started at zero. In other words, typically when you have inflation starting to rear its head, you already have interest rates that are what we call normal rates, which is 2 to 3%. And so to get it above a certain level is not as hard as when you're starting from zero. You've got 2 extra percent to account for. In other words, if inflation doesn't come down once they raise rates to 5%, they're going to keep it elevated until it does come down. There's a lag time between raising rates and when we see the effect in the economy. The other thing that you really have to be concerned about is their objective is to contract our economy. That means a lower GDP, and the definition of a recession is what, two quarters in which you've had the GDP come down, and we've already seen that happen. And so by definition, what the Fed does when they bring down inflation is contract the economy, and contracting the economy is what causes a recession. So what that means is that it's highly unlikely that a soft landing, as Chairman Powell puts it, in other words, raising rates without a dramatic impact, is a pipe dream at this point. It's not going to happen. I believe we will have a recession. The question is, will it be mild or will it be deep or somewhere in the middle? And so that's what economists are trying to ascertain right now.
Given the macro backdrop, do you believe that it's realistic for the Fed to get down to 2%? Are we ever going back to normal?
That's an excellent question. My sense is that not in the time span that they'll be satisfied with. I think that if they get it down to even 3%, then they're going to be pretty happy with it. In other words, we were at a 40-year high when the Fed actually stepped in. You were looking at 9% plus inflation. And the last time we saw anything like that was in 2000 and then back in 85. And 85 through 90 was the worst on record. We had interest rates that were double digit, 15, 16, 70% interest rates. Talk about having a young consumer, even middle class, buying a mortgage or qualifying for it became almost an impossible task. This time they're dealing with something that's more akin to the inflation pressures that we saw in 2000, 2008, to a small degree, those recessions that came on, because typically what happens after they raise rates is we get a recession.
So do you think we're currently in a recession, or do you still think it's far out?
Well, we're not. We do have a contracting GDP. It has contracted for 2, but the last one came in was actually not so bad. Economic indicators say that the economy is still fairly strong. We had so much pent-up demand after the recession and all the stuff that everyone had to go through a few years back. 1, and 2, there was so much stimulus money pumped into the system that it took a while to spend it, to have it work through the economy. And that's what we're seeing now. So I think that in terms of the economy, it's not deteriorating at a tremendously fast pace, but it's still worrisome.
Okay, now, Gary, let's shift to precious metals. What is your read on silver right now?
I like silver, but so do consumers. If you take a look at the amount of gains recently, for example, gold gained about 10% from November, the beginning of November to now, which is so just in about a month. Silver gained more than double that. Silver typically is a candle burning at both ends compared to gold, which is a candle burning at one end. In other words, it burns twice as bright for half as long. So what you're getting is really almost a 2-to-1 differential between when gold and silver, which tend to move up in tandem. There are times when they do not, but they tend to move up in tandem or move down in tandem. And typically silver will outperform gold on the way up, but it will also have a much greater drawdown during periods of correctness or price descent. So I like silver a lot. It's been outperforming gold, and both of them have been outperforming both stocks and bonds for the year. A lot of it has to do with recently when, as I mentioned, we had gold move up 10% in a month. If you compare the kind of moves we've seen throughout over the year, and that's why by factoring in this last month, it makes it look much more attractive. But gold and silver have vastly outperformed returns on bonds and investments in equities. So yes, silver is great.
What about gold? What's your short-term outlook on gold?
Well, the demand has been squashed in terms of physical gold, and even trading in the futures markets, we've seen it trade under pressure. Throughout really March, when the Federal Reserve implemented their first interest rate hike, all the way up till November. So we had this multi-month correction in which it came down from 2,077 in March to a low that began at around $1,620, and we challenged that bottom on 3 occasions. November the 3rd was the last time. And if you consider that it went from $1,620 up to just about, well, right now it's just over $1,800, that's a huge move up in a relatively short period of time. So I think that in terms of gold and silver, comparing them, I don't want to say the tortoise and the hare. Gold has always been a much more stable bet. It is really a inflection and reflection of how consumers feel about certain things, what they think are safe to invest in and what they don't, what we call risk on or risk off assets. And it's also very, very sensitive to inflationary inflection points. In other words, as inflation ratchets up, what happens is gold tends to be a hedge against inflation, so that moves higher. However, what we saw this year was inflation really moving higher, but then interest rates kind of squashing them, because as interest rates go up, that's a negative bias for gold, because when you can get some kind of a return out of fixed assets, in other words, in March, if you were buying a treasury instrument or putting money into a bank, you weren't getting any interest. I mean, at 0.5% or 1%, there's really no return. Even though it's guaranteed and fixed, it's not very much. You can't do a lot with it. And so what happens is as interest rates go higher, it serves the fixed income asset class, because now you can get a return on a fixed income of maybe 2.5 or 3%, which still isn't great, but it's a fixed income. There's no risk. You have to weigh the risk and reward. So what we've seen this year is gold having to deal with on a bullish force, inflation moving up, and then the bearish force of the Fed raising interest rates. The same is true to a large degree with silver, but silver has another component, and that's the industrial component. It's heavily used in the whole green energy movement for solar panels. It's essential in electric vehicles. And so as the global economy kind of starts running on more cylinders, they use more silver. And so that's why you're getting silver outperforming gold.
So we have one more question for you here, Gary. Do you think that we will see younger investors leave the crypto world for precious metals given the recent events?
That's a question that you really would need to ask my son more than me. My son works with me here at our company, and he does a daily blog on the cryptocurrency. So he's much more of an expert.
What's your son's blog? Where can our viewers go to find it?
That would be thegoldforecast.com/Bitcoin. And that will get them to my son's articles. My idea is that digital currencies are here to stay. At some point, I mean, I no longer carry dollars in my wallet. Very seldom do I carry any kind of money, any substantial amount. I mean, everything has been digital, slowly moving since the advent of a credit card. The difference is they control it. With digital, the consumer controls it. Blockchain is brilliant, and it will be utilized more and more into all facets of supply chain and the economics of a particular country, a government, or the world itself. And there's always going to be a place for that, and that place is going to grow. So digital currencies are one thing. When you look at the cryptocurrency space, it's kind of weeding out the bad actors now. We've seen a lot of bankruptcies with certain companies, and so we've had cryptocurrencies like Bitcoin or Ethereum really have some trouble. I mean, I don't know. I think that Bitcoin's right now 16 or 17,000, which is about 50% off of the high. I don't know where it will end up, obviously. I can tell you my belief is that 90% of that space will not be here in 2 to 5 years. Some of these smaller issues, some economists have said it's kind of like the wild, wild west. It is, but there is always going to be a space for digital currencies, and the cryptocurrencies are by definition what they are anyways. And so name brands will emerge. They have, which is Ethereum and Bitcoin. They will always maintain some kind of value. But just as the dollar has no intrinsic value, it's not backed by gold anymore. The crypto space has always been fiat. It's never been backed by anything. The interesting thing, especially with Bitcoin, is they had a way so it doesn't become infinite, that there's a set amount that can be released. And that to me was the brilliance of the programming behind the inception of that cryptocurrency. There are some that have no limits. And so those are the ones that are going to get weeded out.
Okay, great. Well, that's all we have for you today, Gary. Thank you so much for coming on. We always appreciate you coming on and sharing your expertise with us.
My pleasure to be here. Merry Christmas, Happy New Year, whatever holiday you celebrate it with joy and a lust for life, because we've just come out of a really difficult period for all of us. You know, whether you're in your teens, your middle age, or someone like myself that's at the way other end of that bell curve, appreciate what we have, because we didn't have it 2 years ago. So enjoy your family and have a great New Year and a great holiday season.
Thank you. You too, Gary.
All righty. Bye-bye.
Thanks so much for tuning in today. We'll be back again tomorrow with the latest news and updates. So be sure to stay tuned by hitting that notification bell and subscribing below before you leave. Bye.